Loreen is also a leader when it comes to stewardship and giving. She matches her employee donations to charitable organizations, and she employs advanced giving strategies to assist her clients with tax mitigation and creating their legacy. She walks the talk by financially giving to organizations that are improving the lives of women and children as well. For example, she's been a member of the Tocqueville Cabinet and the Women's Philanthropy Fund for over a decade, and she was the co-chair of the WPF Breakfast in 2017. And finally, she was just recently rated on the Forbes Shook Top Women Financial Advisors list, placing her amongst the top half of 1% of female advisors in the US. Please welcome Loreen Gilbert.
Thank you so much, Annie, and it's great to be here with all of you. And you know, I was hoping to be with all of you in person, but we have pivoted and doing more of these webinar presentations. And originally, when we were talking about doing this breakfast, we were going to have a different focus, and that just didn't seem appropriate. Really seem appropriate right now is how can people maintain financial calm during this time? And I want to acknowledge that we do have a serious healthcare crisis, and we do have a serious financial crisis as well. And so in no way are we minimizing either one. And in fact, I had my own health crises in the fall of last year and was hospitalized with a severe pneumonia. And so I empathize with the people who are going through this COVID-19 and how serious it really is. And financially as well, none of us are immune to the financial stress and the pressures that are out there right now. And so, you know, for me, I'm a small business owner. Wealthwise Financial is my business, and as well, I own investment properties that have nobody in them right now. So I understand. So once again, I just wanted to empathize and say we are all in this together. And so I'm hoping that some of these things that we talk about today will help you personally during this time. Just talking about Wealthwise and who we are, our tagline is Wealth Management Redefined, because we're really focused on helping our clients articulate their vision, navigate the risks, and create a legacy. Really looking at those things like still having a dream vision and what that looks like. Navigating the risk is certainly about what's going on now with what's going on in the markets, and creating a legacy for your life and beyond. So that's what we do with our clients, and our values are integrity, confidence, and care when we're working with our clients. Our team includes Annie, that you've met here through Women United, and who just introduced me, and she's a financial advisor on my team, as well as John Milligan, who is our CFA, Director of Investment Operations, and April Martinez, who's our Executive Assistant. So that's our team. So let's get right into, there are things that we can control and things that we cannot control. So we certainly couldn't control that this pandemic came upon us, but there are things that we can do to get us into a better place with our finances. And the first is following a spending plan. Nobody likes the word budget. Nobody likes the word budget because it sounds so restrictive. So what I call it a spending plan, because instead of looking at it as something that restricts you, it's a plan around your spending and what you can do, not what you can't do. And so I'm going to try and address the questions that were posed to us before the meeting, and one of them was about this idea about what are some of the online tools that are available to help with a spending plan. And so I have some suggestions there that you might want to look at. One is called You Need a Budget, YNAB. So you can go online and look at that. Another one that people talk about is Mint. And another resource is Dave Ramsey. And DaveRamsey.com, through his organization, has a Financial Peace University. That's a great program. I've been through it myself, and I would suggest everybody take a look at his program, talking about a spending plan, talking about getting rid of debt. So he has a lot of great tips that I would say would be available. For our own clients, we use an online tool that we call Wealth Vision that does a cash flow analysis and looks at Monte Carlo simulation. Monte Carlo simulation is just looking at probability of success of what if you did this, what if you did that, what does that look like? So that's something that we do for our clients as well. When I talk about reducing unnecessary spending, The good news is right now, some of that spending has been halted for us. I know that, you know, when I look at my own spending patterns, there are things that I was doing before that I'm not doing now. But there could be other things that you might be able to look at cutting during this time. Since we're not going out much, there's really not a need to go out and buy a lot of new clothes, for instance. Certainly nobody's seeing our shoes, so we don't need a lot of new shoes. So there are things that we can do to reduce unnecessary spending. When you can, and if possible, pay down debts. So when you're looking at paying down debts, you definitely want to pay down those debts where you get no tax advantage of holding them. So any kind of credit card debt that is not in a business, let's say if it's personal debt, then you're not getting any kind of tax deduction for that. You want to pay that down. You do, if you have student loan debts, you might be getting some tax advantage for that. But if you've paid everything else off, all credit cards, etc., then you'd want to start working on those debts as well. Right now, with historic low interest rates, if you own a home or a second home, now's the time to refinance and to look at fixing that rate for 30 years. So a couple things I want to address on this. People ask me all the time, what is a good interest rate? And that depends on what type of property it is, and it depends on how much the loan is. So there's conventional limits that are lower, and then there's jumbo limits that are higher. So I thought I'd share a few numbers with you on just my own loans and what I think is a pretty solid rate. So my primary residence, which is a jumbo loan, I'm at 3.375%, 30 years. So if you're around that rate on a jumbo, that's good. Certainly on a conventional loan, it would be less than that. And I have a second home that I'm refinancing right now to get that lower rate. And I was going from a 4% jumbo rate to a 3.625% jumbo rate. Once again, I think those are pretty good. And then for a business building, on my own business building, my loan is a fixed 4%, fully amortized for 10 years. So those are just some rough examples to look at. And certainly we have people that you can talk to as far as your own situation and refinancing, but now is the time. What I'd also say is I've had people ask me the question about going to a 15-year versus a 30-year loan. And what I would say about that is, yes, you can get a lower rate, but you may not want to do that because you may want to look at keeping your expenses lower. And so instead of doing that, I would say, look at doing a 30-year loan and then prepaying it sooner than that 30-year. I'm sorry, my dog is going crazy right now. Give me just a minute to get her down. Hold on. Okay, I'm back. The joys of having our dogs at home with us here. So like I said, I would be careful of going to a 15-year. If you know you can afford it, there's a nice advantage of that lower rate. I have a client right now who's refinancing at a 15-year at 2.75%, and it is a conventional, not a jumbo. So those are some pointers on refinancing. When you look at reducing credit card expenses, once again, you're not getting a tax advantage if you're holding personal debt on a credit card. And so if you're able to reduce your spending, look at reducing credit card expenses and not rolling those over, to the next month, but paying them every month. The next pointer would be building up an emergency savings account. And one of the questions that I get asked a lot is how much does it make sense to have in an emergency savings account? So the rule of thumb has always been 3 to 6 months of your spending should be kept in an emergency savings account. However, I'll say it depends on your line of work. For people who have more consistent and protected jobs, so for instance, government workers right now seem to be the one area where their jobs seem to be very protected, right? And we used to think of teachers also having some protection with their jobs. So it just depends on your job. So if you feel like, and this is a good bellwether to see, is your job secure or not secure? But the less secure you are in your job being maintained, the more of an emergency savings account you want to keep, but somewhere in that 3 to 6 months. And what I'm saying is, in addition to that, you should have a non-retirement account that's conservatively invested, that's a backup to your emergency savings. And what I mean by that is to have an account that might be, we consider municipal bonds to be a conservative investment. Now, even municipal bonds during this time have had gyrations in the municipal bond market, but they are considered certainly a more conservative investment than being in the equity markets. So with that, I would say, think about keeping a non-retirement account that is conservatively invested as a backup. As a next step, on our next slide here, we talk about rebalancing your investments and looking at, what makes sense during times of volatility and what doesn't make sense. It's usually a very big mistake to move all of your investments into cash during volatile times in the markets. And the reason for that is it's very difficult to time the markets. And most people, when you're timing the markets and you're getting out of the markets, you also have to decide when to get back into the markets. So sometimes it makes sense to reallocate part of your investments during these kinds of market conditions, but not reallocating all of it. For instance, if you want it, what we did in our portfolios is we took some money off the table from our fixed income, meaning our bond exposure, so that we could actually increase some equity exposure when the time was right. So what happens in times of volatility, let's say you had a 60% equity exposure, 40% bond exposure. That's what we call a growth with income moderate allocation. During the times when equities pulled back, your equity exposure actually became underweighted to your target risk allocation. So when that happens, you want to figure out, how do I reinvest and get back up to my target risk level, cautiously increasing equity exposure back towards that 60%. And that really means taking a disciplined approach to rebalancing, both when markets go up and when they go down. For instance, last year, 2019, was a great year in the equity markets. Meaning if you, once again, you had a 60-40 split, you actually became overweighted into equities. So what we did in that first quarter of the year, before all of this happened, we actually rebalanced our portfolios to get them back in line with the risk target allocation. And that meant we sold off some equities before the decline. So that helped us during the decline to not be overweighted in equities. And then now, with an underweighting in equities, we're looking at getting money back into equities. So those are certainly some tried and true techniques to have that disciplined approach. And then certainly, as you get closer to retirement, you're going to want to reassess your equity exposure. And this is very personal. It has to do with how close you are to retirement and how comfortable you are with volatility. We use a risk tool called Riskalyze for our clients that we subscribe to that, and we use it with our clients to understand their comfort level with risk. It's part of our financial planning process, is to take our clients through that strategy. And even during this time, what we're doing with our clients is reassessing their risk strategies, because what happens is when the markets go up, everybody thinks they want to be more aggressive. And then when the markets go down, they are not so sure they like that risk allocation. So we're using that as a tool to reassess equity exposure. One of the questions that was submitted was saying, I'm 55 years old, and what do I do? How much do I put into equities versus fixed income? And so to that person, I would say, once again, you need to take an overall assessment of your risk, looking at how long before you're going to retire, but also how long how comfortable you are with the volatility in the markets. One thing to remember though, even for people in retirement, and that is that the average retirement for people is around, let's call it 22 years, even 25 years. So if somebody has a 25-year retirement, you probably need equity exposure. And for instance, we encourage our clients, even who are on the conservative spectrum, to consider having 25% of their investments in equities. That's considered still a conservative investor. Now, if you're ultra conservative, you know, some people want all money in treasuries and municipal bonds, but in order to make accounts grow over time, you need some equity exposure. So I'm going to go through that in a minute and show you some numbers. And I will go back to 2019 because certainly the pandemic was unexpected. No one could have predicted the pandemic. However, we did have a sign in 2019 that a recession was coming. Now, and when I say that is we look at what's called an inverted yield curve. And an inverted yield curve is a very good predictor of recession. Now, it's usually anywhere from 12 months to 2 years out from the time that you invert to the time when we go into recession. And what this chart is showing you here is showing you the 2-month and the 10-year treasury. And what it's saying is, and when I say inverted yield curve, to explain that to people, a normalized yield curve means on the shorter end of the spectrum, rates are lower, and the higher end, longer term is higher rates. So your 2-month rate would be lower than your 10-year rate. That's normalized yield curve. Inverted yield curve means the 10-year becomes lower than the 2-year. I'm sorry, I was saying 2 months, 2-year. In this example, we're looking at the 2-year. So in this example, the 10-year versus the 2-year. And we look at all the different spectrums. So we look at months, we look at years, we look at all of them. I'm just showing you one of these here that shows the 2-year and the 10-year. So when that inverts, and it did invert in the summer of 2019, we were saying to our clients, look, this is showing a weakness. The bond markets are telling us something, and we're probably, we thought 18 months out, because on average it's about 18 months out, which would have taken us through the election. But we did not ignore it. And so what we did during that time is we said, since we see there's an inverted yield curve, we don't know exactly when this is going to happen. We started making changes at the beginning of 2020. And what we did is we moved more towards large cap companies, and we improved our credit quality on our fixed income. So what I want to say is, once again, no one could have predicted the pandemic, but there were things that could be done in portfolios to become more defensive. And that's what we did. Now this chart right here is just to show you that the longer that you stay invested in the market, the greater likelihood for a positive return. And so what this shows you is looking at monthly returns, and these are rolling returns of stocks ever since 1928. So by the way, that takes you through the Depression era. So we've been tracking stocks since 1928 through the present. And if you look at monthly rolling returns, you still have 62% of the time a positive return and 37.6% a negative return. And then if you go out longer, just go out to 5 years, you're at almost 89% of the time a positive return, only 11% a negative return. And if you go to 10 years, it's even greater. It's almost 95% of the time positive returns, 5% are negative returns. And so when you hear people say and talk about, well, if you're a long-term investor, then you don't need to worry as much about short-term volatility. That's true. And so once again, even for people who are in retirement, we're not going to have them 100% in equities, but even with equity exposure for people in retirement years, should be considered, because over the long term, you're going to earn more and you're going to have positive returns if you look at the long term. Another chart I like to show people is this one, and it goes to intra-year volatility. And what this chart, and I know there's a lot of numbers on here, but I'm going to focus you on a few of them. So what those negative red dots are on the bottom are looking at, in the middle of a year, how low did the market go, specifically the S&P 500, in the middle of the year, and the graph in the bluish gray is where the S&P 500 was for the whole year. So let me just show you a few of these numbers here that are quite large on the negative, but still had some positive returns. So look at 1987. If you look at that 1987 number, we were down 34%. And that was the October Black Monday. So Black Monday in 1987, we were down 34%. But the calendar year return for the S&P 500 was a positive 2%. And then look at what happened in the next year, in 1988 and 1989, with very high positive numbers. Okay, that's one example. Now, another one would be, if you look at some that weren't as drastic on the downside, but still ended up, if you look at 2000, right around 2009, 2010, you can see that we were down 16%, but up 13% for the year. And the year before that, down 28% at one point during the year, but up 23%. So those are some significant numbers. Now, it doesn't always happen that way. You can look at the period of 2000, 2001, 2002. You might remember that era where we had some pretty significant downturns in the market. You can see a negative 30% and a negative 34%, and we still ended up down those years. But look at what happened afterwards. We shot up and had a positive 26%. So all of that is to say, you can have a very big intra-year decline, like this year. If we look at 2020, down 34%, and year-to-date, down 15% on the S&P 500. At one point, what that's saying is, at one point we were down 34%, we now recovered down to negative 15%. So we will eventually pull that up. Now, does that happen this year? We don't know. And I'm telling people, be ready for more downside volatility. I don't think that we're done with downside volatility for the year. But certainly the markets tend to, at some point, bounce back and we go back into the positive mode. So I think this is an important chart for people to look at. And the other point to make is that if you can't handle, if you don't want that big downside drop, then you have to limit how much equity exposure you have in your portfolios. So that's that whole back to risk. And also the other thing is, if you sell into a decline, that gives you a permanent loss. So you have to be very careful about making emotional moves in the market. And we're going to talk about that in a minute. So let's talk about other things you can do to help you with your kind of financial well-being and your financial health. And that is consider avoiding excessive economic news. And I know that it's tempting because we live in a world where we get notifications in every way. On whether it's on your iPad, on your phone, you're constantly getting alerts from various news sources. And so consider limiting your exposure to kind of that economic news every single hour, unless it's necessary for your job. More like me, we're looking at things all the time. But for most people, you don't need to look at economic news on an hourly basis. Another pointer would be to consider a few news sources that you enjoy hearing from and sticking to a time limit with those, not having the news on 24/7. And that means just staying informed without succumbing to the stress that comes from all these different inputs that can actually create more stress. And in our in our slide here in our pictures, what's interesting too is one moment you can hear one person's opinion that says, you know, hey, bear market isn't over, and then another one saying, hey, the stock market is rallying. So people have varying opinions, and so just in a sense limit that overall exposure. So some other strategies for coping with anxiety is, what are some of the other things that you can do to be positive during this period of time? Certainly exercise, yoga, meditation, you know, prayer, different relaxation techniques. There are many resources online that you can take advantage of. I downloaded this breathing zone application. One of my friends told me about it, and it just helps you with your breathing and to keep you calm. Another one would be to connect with a counselor on the phone, because everybody's doing phone connections. And then online gym classes to keep yourself physically healthy, and even online worship services to keep that connection and to worship. So those are some of my thoughts on coping with the anxiety around financial stress. And then looking at how are you making your financial decisions? We want to take a step back and make sure that you're not basing your decisions on emotions. And I will tell you, after being in this business for 30 years, that our motivators with finance tend to be fear and greed. And people tend to gravitate towards one or the other and then shift. So in times of markets going down, people become very fearful. And in times of market exuberance, people tend to get greedy. And what we try to encourage our clients to do is to find that, once again, your risk tolerance level, and to stay in that risk tolerance level and not make big shifts, because those big shifts can really hurt you if you're let's say selling into a downward market and basing your decision on fear. Most importantly, consult with a financial advisor who can give you objective information, objective opinions, and who can also give you financial advice and guidance. The best use of a financial advisor is to keep your own emotions out of the investment process and to let them stay the course for you and to make good decisions. So making sure that you're working with somebody who is giving you good decisions, of course, is important. And then I want to touch on the giving aspect and talk about consistently giving. Now, giving is something that people can do when they have resources, and certainly people who are out of a job or in severe financial stress right now cannot be giving, certainly to the level that they were before. But for a lot of people, they're in a position of not being under that situation. Maybe your job is secure and you can consistently give. But I wanted to share with you some of the things that I encourage our clients to do, and some of the things that I've done myself, and thinking about my own philosophy in giving. And my own philosophy in giving has been to proportionately give. In other words, the more I make, the more I can give. And the less I make, the less I can give. It's proportionate to what you make. And the other thing is to help you make your giving more consistent, consider using a donor advised fund. So I use one myself. We encourage our clients to do it as well. And a donor advised fund is a way, when you have really good years, you're funding that with more money. And it becomes this holding place for your giving dollars that then you can give to charities maybe on a more consistent basis. And it can help you level out your giving so that while you may have years that you're giving less and other years you're giving more, you're making your financial commitments more stable. Because as we know, nonprofits, when the economy goes down, nonprofits really suffer. They really have a hard time. If you've been able to use a donor advised fund and accumulate more money, you can actually help your nonprofits have consistent giving during periods of financial stress. So that's something that we do. So a donor advised fund, once again, just if I wasn't clear, you're not familiar with the concept, it's its own nonprofit. And then you get to name it whatever you want to name it. So mine is called the Loreen Gilbert Charitable Foundation. So I've set it up. I fund money in there every year as that giving conduit. From there, I can give money to my nonprofits. Another way to look at it is through Women's Philanthropy Fund. For those of you who are in Women's Philanthropy Fund has the same concept where we put money there and then it can go to different nonprofits. But your donor advised fund can be named whatever you want to name it, and it becomes your own giving pool of money. And then the other thing that I would say is to think through your giving strategies as far as just specifically with what's going on this year. So this year, there has been the CARES Act implemented. And the CARES Act gives people an advantage on their giving strategies. So it allows you, before we were allowed to deduct 60% of your income for giving. Through the CARES Act, you're actually allowed to give up to 100% of your adjusted gross income, just for this year, for 2020. So if you find yourself in a position of being able to give more, this is actually a great year to take advantage of this new adjusted gross income limit. In addition to that, it gives you, if you don't itemize, just for 2020, it's allowing people to deduct $300 this year to give to nonprofits above the line instead of having to take it as a deduction through your itemized deduction. So there's a couple of provisions there that are helping people to donate more. I'm going to be providing Orange County United Way with those talking points on the CARES Act and for them to distribute to everybody. So be looking out for that. We're going to be following up with that piece with more information. And with that, that is my presentation. And I want to make sure that I've covered, oh, there were a couple of questions that were submitted that I haven't covered yet. So let me cover those and then I'll answer any additional questions. One question was, is it a good time to open a 529 or other college savings account? And what I'll say is that the beauty of a 529 plan is that it acts like IRA, meaning it's tax money that goes in, that grows tax deferred and comes out tax free as long as it's being used for college education expenses, like tuition, like books, computers, things like that. So yes, it's always a good time to put money into a 529 plan as long as you have the ability to make those contributions. Because once you make those contributions, that money's no longer yours. That money goes into that account and must be used for, you know, that other person's education. So there's lots of rules around that. The other thing I'd say about the 529 account is it is limited to one time per year on being able to make investment allocation changes. So it doesn't work like your 401k where you can just move it around all the time. So you need to make sure you have it in an allocation that you're comfortable with during market volatility. So just keep that in mind. Another question that I got was, what about my 401k? Is it a good time to be putting money into my 401k, or should I, you know, make some changes on that? Oh, the actual question was my 401k and stock purchase program. Should I keep it at the same levels or reduce it? You want to continue to put money consistently into the market. That's what's called dollar cost averaging. You're buying in at different levels of the market. So when you're buying in at lower levels, your cost is actually lower and therefore when the market goes up, you'll actually make more money. Now, when it comes to the stock purchase program and what you're able to do with the stock purchase program, make sure you're limiting your contributions to only 10% of your net worth into a stock of any particular company. You want to, that's kind of the rule of thumb that we have, is 10%, no more than 10%. And I'll give you an example of people that were overweighted. Many Boeing employees had a lot of their money in Boeing stock. And Boeing stock had been doing incredibly well. So they had made a lot of money. we advise clients, do not be overweighted. Make sure you only have 10% of your net worth in Boeing stock. Well, look at what's happened to Boeing stock. It was decimated. It's a great example of you have to follow these rules of thumb to protect your overall assets and make sure you're not overweighted in any one stock, even if it seems like, oh, the stock is doing great. You've got to be careful with that. And then let me just look and see if I have any other questions. I'm going to let Amanda, I'm going to let you look at questions, and I am going to put you on mute just for a moment while I let's see if I can, while we bring in those questions, and I'll be right back. I'm going to be right back.
So yes, if any of you guys have questions that you'd like to ask based on the presentation or just any other thoughts that you, or now that you're listening, feel free to enter them into the chat feature below, and then I can pass them over to Loreen as she's doing more Q&A.
Yeah, I'm just making sure that we've covered all the questions that were submitted. One of the questions was about refinancing and said, you know, we discussed refinancing, but somebody asked the question, as low as they are now, are they going to drop any further? Here's my opinion, refinance now. The issue was for a period of time, actually the banks were freezing refinancing. And some banks, you know, even if one bank says, hey, we're not refinancing right now, you can find another bank that is. So refinance now, because we are at historic low rates. This is a time to go ahead and do it. Maybe it goes a little bit lower, but you want to lock in now for the long term and make sure you don't get caught up in rising interest rate environment, or once again, when the banks aren't lending. And then the other rule of thumb around that is try to make sure that when you're refinancing, it actually makes financial sense. You can't incur too many costs in refinancing for it to make sense, or you want them to figure out what your break even would be. So for instance, in me refinancing my second home, I'm getting a lender credit that's covering all my closing costs. It's not costing me anything, and I was able to reduce the rate. So those are the kinds of things that you want to look for in refinancing. Okay, so do we have any additional questions?
Yes, Loreen, there was a question. Apologies if this was covered, but is 6 months of cash savings still recommended in this downturn in the event of a job loss? That was the mantra in 2009, and most of us elder millennials stick with that. Is that too conservative? Or is that enough? Elder millennials equals started career in recession. That makes sense.
Oh, right. Yeah, so that goes back to that question. Depends on what kind of job you have and how secure it is. But if you don't have a job now, you know, having that 6 months is really going to help quite a bit. And then, like I said, by having a backup of another account that has more money that is liquid that you could access, but that's invested. So the issue is that you're not going to make much money sitting in a savings account. So you want to have enough that you can access cash when you need it, but not so much cash that you're not making any money on your money. And that's why I say use that secondary account as a, you know, maybe a municipal bond strategy or something like it that's considered a conservative investment, that if you needed more money, you could access that. And listen, every recession that I've been through, I've learned lessons. You know, so we always learning. What I would say about this recession in particular is, for me, is having even more cash on hand because you never know. Even our great predictors, when we saw there was probably going to be a recession, but it was probably going to be further out, something can happen unexpectedly, and you want to make sure you've got cash on hand. So having that cash in a savings account, and then, like I said, as a backup, conservatively invested. Because if you have a conservative allocation that's a non-retirement account, it's still invested for you, but if you needed it, you can get access to that money. Did I miss any other questions, Amanda?
No, those are all of the questions that we have in. Is there any more that anyone wants to ask?
This is Nisha. I just want to say that I was the one that had that question, and I am an elder millennial. So I just want to say thanks. That was really helpful and puts me at ease.
Good. And if anybody has further questions, they're welcome to contact us, Annie and myself, at 949-748-1177. And Amanda can always direct you towards our office as well. Let's see, let me make sure. Oh, there's a chat room here. Was there anything else? Let's see.
Hey, I don't have a question. I just really want to say thank you. This is Trina Norman. Thank you so much. Great presentation today. Thank you.
Oh, thank you. Appreciate you being on the call. Appreciate everybody being on the call, and we're here to help people. So, absolutely.
Yes, perfect. And then I will pass it over to Nisha if there's no further questions. And Angel, to answer your question, yes, we will be sharing the presentation. We've actually been recording it. And Loreen, if it's okay with you, I'm happy to share those slides as well. And everyone will kind of get nice information from me at the end. So yeah, I'll pass it over to Nisha.
Yeah, everyone, good morning, and thanks. I'm so happy to see that so many of you were able to take the time to log in, because we're all trying to keep up with a lot right now. So I just want to encourage you to just keep in touch with us and each other as much as possible, you know, as we're still stuck at home, and kind of appreciate your engagement, and those of you that donated to the Pandemic Relief Fund, we appreciate that greatly. Susan sent out some information about some virtual scorecard events that should be helpful, and I think the kind of request to all of you is that if there's anything else that anyone at United Way or anyone on our team can do to help you either stay connected, stay in touch, get more information, let us know. If there's anything that we could do to help you in any other way, let us know. I just think it's important that we all stay connected and remain to be a support network.
And
I think that was it, right, Amanda?
yeah, just so you guys know, we also have some more upcoming events to stay connected with United Way. So we have our first of 3 scorecard series, which is Reimagine, which will basically be our transparent work of what we're doing, so you can kind of see our progression. So that'll be tomorrow at the 29th. And then also we have 2 more coming. I think there are 2 more in the beginning of May. And then also we have our Women's Philanthropy Fund breakfast, which will be on May 20th. So we encourage you, the save the date will be sent out this week. And so we encourage you to sign up and join. We will still have our keynote speaker, Kareem Abdul-Jabbar, sharing. And so you'll get a nice email from me that has our Pandemic Relief Fund information, the slideshow, the presentation, and how you can sign up for all of our other upcoming Reimagine virtual events that we have going on for this spring. So you'll get a nice, beautiful package from me later this afternoon.
Hey, Amanda, Leanna had put in the chat about the Pandemic Relief Fund, and I know Nisha responded, but maybe if you could also include it in that packet.
Yes, I will do that. Mm-hmm.
Awesome, thank you.
Thank you, Amanda, for everything and for putting this all together.
Perfect. Well, thank you so much, everyone. And thank you so much, Loreen. That was really insightful and extremely helpful. Everyone is sharing that. It was so informative. So thank you so much.
Thank you so much. See everybody, hopefully in person soon.
Yes. Everyone stay safe. Thank you.
Bye.